Hello everyone and welcome to Fun with Fitzy. This is the second video in Chapter 14 and we're going to be talking about shares and shareholder equity. Some things you need to know about shares, and remember shares are the things that you buy when you purchase some ownership in a corporation. There are terms that corporations must need to understand when dealing with them. So authorized shares are the maximum amount of shares a corporation is allowed to sell as authorized by their corporate charter. It may be an unlimited amount or a certain number, like 500,000. The term issued shares means the number of shares that they have already sold. So some things that corporations need to take into consideration when issuing shares. How many shares should be authorized for sale? Which also means how many shares should they be able to sell in the next several years in order to raise some capital. How should the shares be issued? At what price should the shares be issued? What value should be assigned to the shares? And so on and so forth. The stock market, so everyone has heard of the stock market. This is where the shares of publicly held companies are traded. Now remember, we said there was publicly held companies or corporations and there was private corporations. And the public corporations are the ones that are sold on the stock market. And there's like Toronto stock market, the New York stock market, there's several around the world. And the price per share is established by the interaction between buyers and sellers. It's kind of like in economics. When there's high demand, the price will be higher, and when there's low demand, the price will start to go down. So this is why companies are always concerned about their stock price falling. So if they don't perform well, they're not doing very well, then there will be low demand for it, and the price will start to fall. Whereas every time a company reports earnings that are higher than they expected, their stock price starts to go up, and people will want to buy it. So there are a couple kinds of shares that we need to know about it. There's stated and par value shares, which are very similar to each other. Stated value shares, they assign a value to no par value shares. So what this means is for stated value, whatever that value is, it becomes the legal capital per share, and the stated value may be changed at any time by the board of directors. Par value has legal significance. It represents the legal capital per share that must be kept in the business for the protection of corporate creditors. That amount cannot be withdrawn by shareholders, and so corporations are required to sell shares only at par value or above. Okay, again, so we must retain legal capital in the corporation. So for both par value and stated value shares. And this price has no relationship to the actual price of the share, but you have to sell the share at least higher. And I'm going to give you some examples of this, and this will come more clear as we go through it. No par value shares are the most popular shares today. There is no assigned legal capital value. A no par value share is share capital that has not been assigned a value in the corporate charter. If shares have no par value, the questionable practice of using par value as the basis for legal capital never arises. No par value shares are the most common form of shares today. More than 90% of Canadian public corporations now issue no par value shares. So these are the most popular ones, and we'll be dealing with mostly. Legal capital equals issue price, so it equals the proceeds. And they must retain legal capital. No par value has no relationship to the market value once issued. Again, similar. Okay, here's a little chart here that will be helpful for you. Here's the amount of legal capital per share that has to be retained in the company. So for par value, let's say you're selling $10 par value shares and you sell it for $14. Because it's a $10 par value share, $10 has to be retained in the corporation as legal capital for each of those shares sold. No par value has no par value, so let's say you sold this one for 14, the entire 14 has to stay. And again, stated value, it acts very similar to par value. If it's $10 stated value share and you sell it for 15, $10 has to stay. Okay, so let's look at some journal entries here. Shares are most commonly issued for cash. That means the corporation sells the share in exchange for cash. And when no par value common shares are issued, again, the entire proceeds from the issue become legal capital. And so some new accounts for you are here. So the first one is common shares. It's kind of like capital, you would say. So it's a credit. It increases shareholders' equity in a corporation. So when you sell shares, when you initially sell shares, and this is to record the issue of 1,000 shares that they sold. Let's see the amount. Let's say obviously they're selling 1,000 shares at $1 each in this particular case. So you've increased your cash by $1,000, and you've increased common shares by $1,000. It's a credit, normal credit. So let's talk about shareholders' equity, similar to owner's equity. So on a corporate balance sheet, you don't have an owner's equity section, you have a shareholders' equity section. And the shareholders' equity section of a corporation's balance sheet consists of two main sections. One is contributed capital. Contributed capital is the total cash or assets, if you're exchanging shares for assets, paid by shareholders in exchange for share capital. This is like the owner investment. This is like capital, owner's capital. Only the capital that is normally invested in a small company is invested by the owner. And you guys know that when an owner invests, you credit capital. Well, when a whole bunch of shareholders invest, we're going to credit those common shares and things like that. But the whole section of the balance sheet here is called contributed capital. And there will be different classes of shares. So there'll be share capital. There'll be additional contributed capital. And we're going to get into this, but really additional contributed capital is anything that you sold above what you needed to legally keep in the company. So for example, when we were talking about par value shares and you sold the $10 par value shares for 14, well, the $4 extra will be the additional contributed capital. And it's going to go in that section. So the $10 is going to go here and the $4 are going to go there. These are both credits, and you're going to debit bank by 14. Retained earnings is the second section. Retained earnings is all of the net income the company has earned over time that has been retained in the corporation, so kept in. So if the company has earned $100,000 in net income over time and they've kept it all in the corporation, that means not given back to the shareholders, then the retained earnings for the corporation would be $100,000. However, if they have given some of it back to the shareholders through dividends, let's say in that particular case, there was $100,000 of net income over time, and they've distributed $20,000 to shareholders as dividends, then the retained earnings in this particular company would be $80,000. Okay, so you need to know what retained earnings is. Net income or cumulative net income that has been retained in a corporation minus any dividends that have been distributed to shareholders. Retained earnings is the account we're going to be using now for closing entries instead of capital, because we no longer have capital. We're not using contributed capital. Okay, we're going to be using retained earnings as our closing. Okay, let's take a look at a shareholders equity section. Like I told you, there are two sections mainly on one of these things. Here's the first one, contributed capital. Here's the retained earnings. And again, retained earnings is net income minus any dividends given out. So in this particular case, $800,000 has been contributed to this corporation via shares. They were common shares, and we're going to talk about common shares and preferred shares in the next video. But 100,000 no par value shares were authorized. That means they were authorized to sell 100,000 of them. However, they've only issued $50,000. So if we look at this, how much did they sell each one of those shares for? You can actually calculate here how much each of these shares were sold for, or how many shares they sold. If they have $800,000 in contributed capital and they've only issued 50,000 shares, well, 800 divided by 50 equals 16. So on average, each of these 50,000 shares were issued at $16 or sold for $16. The company still is authorized to sell 50,000 more. So there's lots of information in the contributed capital section, and there's going to be even more as we go on. But for now, that's a good introduction. And again, retained earnings, you know what that is. Okay, let's look at the journal entry when there's a stated value or a par value. So here the stated value is credited to common shares. When the selling price exceeds the stated value, the excess is credited to account called. So this is an actual account name. Contributed capital in excess of stated value. Okay, so let's look at this journal entry. They have earned $5,000 by selling shares. And they said here that they sold 1,000 of them. So really, what has happened? They sold each of these shares for $5. But they must have been $1 stated value. So when they sold 1,000 $1 stated value shares, that $1 for every share went into an account called common shares, and that's a credit. And then anything above that stated value, so there was $4 above that stated value, goes here. So the $4 extra per share goes in contributed capital in excess of stated value. And this is the same for par value shares too. The word just changes. So now let's look at this shareholders' equity section. When you have contributed capital in excess of stated value, you will have another line here that shows this. So let's analyze this one. In this particular company, there were 10,000 shares of $1 stated value authorized, and they've issued 2,000. Because they were $1 stated value, the entire $1 has to stay in common shares as legal capital, and they issued 2,000. So there's where this 2,000 comes from. But obviously, they sold those shares for $3 because there's a total contributed capital of 6,000, and they sold 2,000, so they must have sold them for $3 per share. $1 had to stay here. Remember, there were 2,000, so 2,000 times 1 is 2,000. And the additional $2 has to go in contributed capital in excess. So there's the 4,000. So in total, they've sold shares for 6,000. They've sold 2,000 shares for $6,000, and they've divided them up into just two different accounts. Really, is all we have to look at it as here. And of course, this company has retained earnings of $27,000. Remember, retained earnings is any net income over time, subtracting out any dividends given to shareholders. Sometimes shares are traded for non-cash assets or services. For example, a lawyer, if he provides a service to a corporation, the corporation might give him shares instead of cash. Sometimes land is traded as well. So when common shares are issued for services or non-cash assets, cost is either the fair market value of the consideration given up or consideration received. So let's talk about consideration. Consideration is what you trade. So usually we trade money for an object. So in this particular case, when a company is giving up common shares, you have to determine, is it going to be the price of what we're giving up, how much the share is worth if there's a fair market value? Or if there is no fair market value for the share, what are we receiving? How much was that lawyer service performed? Okay, but we're going to go with the consideration of what we gave up first. So if we do have a fair market value for our shares, let's say they were $10 per share, and we gave them 10 of them, then the consideration we gave up was $100. So that's going to be the amount for our journal entry. If we didn't have this fair market value, but the services we received from the lawyer were worth $150, then we would have to value the transaction at $150. Okay, by now you should be able to determine some different terminology around shares. Authorized, number of shares authorized, number of shares issued, that sort of thing. You should be able to know how to journalize when there's a sale for par value, stated value, and no par value shares. You'll have to know what the shareholders' equity section looks like, the two sections, contributed capital and retained earnings, and within the contributed capital, the common share section and the contributed capital in excess of par or stated. Thanks for watching. Hope this helped.